Hey guys, so today I want to respond to an interesting comment from one of our viewers in response to one of my older videos where we looked at the year-to-date returns of high debt companies versus low debt companies, and we wanted to see if there was significant difference between those. And this viewer had a really interesting suggestion, and his feeling was that maybe you should look at year-to-date returns of companies per sector. And that would be more telling of if there really was a statistically significant difference between high debt companies versus low debt indebted companies. So I wanted to test that hypothesis and respond to that comment and see if that's true. Let's see if that is the case. So what I've done here is I've actually pulled our data from FinViz again, and I've exported the CSV file from FinViz and put it into a data frame, just like in our last video. You'll notice in this data frame, there's actually a column called sector. And so what we can do is, this is just showing the number of securities in our data frame. But what we can do is, first we want to take our performance year-to-date return and we want to convert it into a numerical value because it's actually a string in this data frame. So that's what we're going to do. And we have to strip off the percentage sign and put it into a float. More importantly, so once that's done, more importantly, we have this sector column, and you can see the unique sectors in here. So we have technology, utilities, industrial goods, consumer goods. What we can do is we can specify new data frames per sector. So we can have a data frame that just looks at healthcare companies, materials, financials, etc. So I've done that here, where I take each of the sector columns and make it equal to a specific sector name. And then I specify a new data frame just called DF. So I take the one that I'm interested in here for this specific IPython notebook. And for example, we're going to look at consumer for now. So first we want to state our null and alternative hypothesis. So what is our null? Our null is what we want to test for or test against. And so here we're going to look at high indebted consumer sector company year-to-date returns equal low indebted company sector year-to-date returns. And so basically that's saying that there is no significant difference. Versus our alternative hypothesis, what we do want to test, that is that high indebted consumer sector company year-to-date returns do not equal low indebted consumer sector company year-to-date returns. And so we can specify that in mathematical form like this. So again, we're going to have to identify our test statistic and probability distribution. This is the test statistic that we will be using. We're going to assume normal distributions, independent samples, and we're going to assume the variances are equal. And so between the two sample populations. So what we can do is we can find the population sample here, or excuse me, the sample set, and for our total over the companies within the consumer sector that have debt that is greater than equal to 1. And I've also specified the market cap of these companies be greater than 100 million, just so we can exclude any outliers in the data set. So you'll notice that we have a sample size of 86 for those companies, and for the low indebted companies, we have a sample size of 159. So our degrees of freedom is 243. If you're interested in this math, you can look at one of my other videos where I go through this. I have to specify our decision rule. So these are our rejection points, and I'm going to do a two-sided test. So I have a negative 1 point. If our t statistic is larger than 1.96 or larger than negative 1.96, so then we can reject our null hypothesis. Remember, that was, yes, there was no difference between the year-to-date returns of both these high indebted consumer companies or low indebted consumer companies. Therefore, they're just equal. If we can reject that, we can accept our alternative hypothesis. So we can now collect our data. And then so I've collected the data. Remember, these are just consumer companies, and it's very similar to my last video. I can look at the year-to-date returns of both these sample sets. Low debt year-to-date returns, we can specify a histogram. And we can look for both of them. You notice they look somewhat normally distributed of equal variance. And then we can actually pull out the means or the averages. And so we can see the high data companies had a negative return of 38% versus the low debt companies had a negative return of 37%. Not very far off to each other. They look rather similar. Then we can look at the variance of both these distributions, seem somewhat close. And finally, we can actually conduct our test, our t-test. And we can just use our stats models, which is what we do here is from SciPy, we import stats, and we can just say t-test of independence and put in our arguments for both our data frames, our high det data frame, our low det data frame, assume equal variance, and then we remove our NaN, or not a number policy, and just omit those. So you'll notice that we don't have a p-value less than 0.05, and most importantly, our t-statistic is just negative 0.25. So that is smaller than 1.96 or negative 1.96 as well. Therefore, we cannot reject the null that high indebted consumer sector company year-to-date returns equal low indebted company sector consumer sector company year-to-date returns. Therefore, we cannot accept our alternative hypothesis. So basically, there does not seem to be a significant difference between high debt companies versus low debt companies in the consumer sector. So that was very interesting. So I'm glad we conducted that. Now let's take a look at some of these other sectors. So we can look at services. Now the services sector, that's very interesting. There's a lot of different companies in there. So what I've done here is I pulled the data from our CSV file, but remember I specified a new data frame called all these different data frames here and we're going to look at services now. So services, we can just change this, our new data frame that we're going to modify to services. And I'm going to have all this data in my GitHub so you can actually run these yourself. So again, we stated our alternative, or null and our alternative. This time we're looking at services sector company year-to-date returns. Same idea, same distribution, same assumptions of normal distributions and equal variances. Again, everything here is the same. Just notice that for our services companies, we have a sample size of 198 versus our, for high debt companies of 198 versus our low debt companies of 306. And actually what would be interesting is to see what is in services, right? What do we want to see that? So let's just run some of these. So I'm going to run through some of these here. So if you notice, we can just say services. There we go. So you can see some of the companies we have in our services sector. So we have, and I don't recognize everything here, but we have a lot of transportation, trucking companies, Build-A-Bear Workshop, that's interesting. We have Baker Hughes Company. Wow, there's a lot of companies in here. Kelly Services, Dick's Sporting Goods, Big Five Sporting Goods, Hibbett Sports, those are all company. Planet Fitness, SeaWorld, Etsy's in there, that's surprising. Sally Beauty Holdings, I know that one for sure has a lot of debt. Ulta Beauty, Starbucks Corporation. So you can get a sense of what type of companies are in the services sector. Yum China Holdings, they own the Taco Bells, and Yum Brands, they own Taco Bells and the Pizza Huts in China and the US. McDonald's. So those are the type of companies in the services sector. So let's actually run through our hypotheses again. We're looking at high debt versus low debt service companies now. That's our no, that they're equal. Alternative is that they're not equal. Again, we're using our same t-statistic, and so we can run through all of this again. Look at the distributions. They look normally distributed. Look here, there is some outliers here, so that could be an issue. You could actually clean that up, but we won't do that for this one. We'll look at the average here. Now, let's look at the mean. So the high debt companies in the service sector have a negative return, year-to-date return of 47% versus our low debt companies of 38%. That looks different. So we have to test that though. So let's look at the variances. They look somewhat close. So again, we can use their same stats library, assume equal variance, omit any not a numbers from our data set. And you'll notice we have a p-value of less than 0.05. And our t-statistic, more importantly, is very large, of negative 4.73, which is larger than our rejection point of negative 1.96 or 1.96. Therefore, we can reject this null, that the year-to-date returns for these service companies are equal, and accept the alternative hypothesis that they are not equal. So very interesting. So again, I'm very happy that Now, our viewer suggested this. This was a really great exercise for us to look at specific sectors and see where were the significant differences between high and low debt companies. So thank you. So now let's take a look at some of these other companies, and I'm just going to run some of these other sectors, and I'm just going to run right through this, and you can do some of their own tests later on your own. And what I've done again, so in this one I'm looking at industrials, and so this is the last one I want to go through. I just want to specify what I've done here. So again, we're looking at different industrial sector companies, year-to-date returns. We're stating our no and alternative. Notice that we have total debt here of these companies greater than 67, and for low debt companies 165. Again, we have our degrees of freedom. And so what I want to do here is I want to show when outliers can be an issue in data. So that's the exercise I want to produce here. So again, we're doing the same idea here. We're collecting our data, calculating our test statistic. And now let's go here to our distribution. So we can look at our high debt industrial sector companies and see this looks somewhat normally distributed. But let's look at their low debt companies. Here you'll see this looks normally distributed, but we have this very large outlier. And so if we run through this, we can look at that outlier first of all, and you'll notice it's this company called APT. And APT, if some people may be familiar with this, is I believe produces masks. And in the recent health crisis, this has been a company that has had a lot of investors interested in this company. So so that's a very interesting variable in itself, or a very observation in itself, but it could be an outlier. So what we could do is we can move this. But before we move it, let's just run through this, and we can look at this distribution. And here, again, that's the same. So we can look at the mean. So let's look at the high debt versus the low debt industrial companies. And so we have a negative 46% year-to-date return for our high debt companies in the industrial sector, and a negative 38% return for our low debt companies. So that looks different. We can assume the variances are similar. They actually look a little bit different here. And so we can run our t-test. And again, I'm assuming equal variance. And look here, this is a p-value of smaller than 0.05. So yes, this is statistically significant. But let's remove this outlier and again look at this. And so what we can do is we can run this. And so what I'm doing here is I'm looking at all the companies that are larger than 100% return, basically, of 1. And I can remove it here by using the not equal sign here from our data frame. So I'll do that, and then we can run the histogram again. And here you'll notice that it does look better. It's normally distributed. Again, see, we're massaging the data, which is good and bad at times. And so, but in this case, I wanted to remove that just because I do believe it's an outlier. Now we can run through our means. You'll notice the difference is less. We can run, and also the variances are closer. So we can run our t-test again, and we have a better, the good thing is we still have a p-value less than 0.05, and our t-statistic is negative 2.4. But in some sense, in some instances, an outlier will skew the data, and it did, as you can see it. The t-statistics did change. But fortunately, in this case, at least when we're testing our null and alternative, we can still reject our null and accept our alternative hypothesis that there is a significant difference between high and low debt companies in the industrial sector. So if you like this video, guys, please subscribe. Again, a shout out to one of my viewers. Thanks so much for suggesting this. And till next time, guys, thanks.